Guys, Killstokes here. Today we're talking day trading, ascending triangles, and your favorite topic, range bars. Let's hop in. Yeah, we've got a little ascending triangle action happening here as well. A lot clearer as you go down to the lower time frame. Now, again, this is an interesting one because usually you see this go from the other direction. In an ascending triangle, you typically see the directional move before the ascending triangle be in the direction of the breakout. This is an opposite one. The directional move is down and the ascending triangle is up. You play it the same way though, and if you're looking for a buying opportunity, what you would want to see is you would want to see a violation of this high or these highs. Now, the tough part is, if we violate those highs, is there room to make profit, right? That's the interesting dynamic about trading. We can do all of the analysis in the world, and we will do all of the analysis in the world. But ultimately, there also has to be opportunity to take the trade, meaning there has to be enough room to go for us to make money. And if there's not, then it's not a tradable opportunity. So when I'm looking at this as far as, okay, if we violate these highs, then I expect price action to go up. If we go up, excuse me, where are we likely to go up to? There's a few things that stand out. We'll just work from right to left. Yeah, right to left. The first zone that stands out is going to be right here. This is our previous little bump in the road before going down. Price action rallies down. We consolidate, retrace a little bit before going down. So I think a pretty obvious level right there. We have 162 even handled number there as well. Looks as if that would be a 50% Fibonacci retracement right in that zone. I'm probably right, but let me just draw it in regardless. Told you. Yeah, why did you doubt me? That's one zone. However, if we look left, we've got another level. I'm going to steal this line. And we've got another level of inside structure right about here at about 161.84. So the question that we want to ask is this level important, or how important is this level? Because there's certainly room to travel from a high of 161.70 to 162 even, 30 pips or so in there. To travel from 162.70 to 161.80, that's a whole different story. So if I wanted to determine how important this level might be, what is something I might do? Yeah, volume. This is where that magical volume comes into play. Again, in the past, and what is it, 3 years now, 4 years now, I would just have to make a decision, and I would always go with the most cautious decision because I am a risk-averse trader. Now I can kind of get a clue and say, hey, how much does the market care about this level? And you can see there's a nice little void here. It doesn't really start to pick up, honestly, until you get a little bit higher at about the peak here, peak of this part, of about 62.15. So I do think you're okay shooting for the bottom of this green zone, about 61.94. So we don't really have any big volume spikes in that level. So again, it's just a little thing to tell us that, hey, if I'm trying to determine which of these levels is more important than the other, then that volume plays a role. All right, so now we got an ascending triangle. We've got a target level. Now the question is, right, and this is when you go through your trading plan, you find the section, do the lick the finger thing, find the section that says ascending triangle. How do you trade it? And we know there are three ways to trade breakouts. There is the before, there is the during, and there is the after. The before would be for some reason that you would find buying it now in anticipation that the breakout will occur. The during would be buying it during the breakout. I'm going to give you guys a pop quiz. If I wanted to buy it during the breakout, meaning as price breaks out of this level, what type of order would I use? Dun, dun, dun. Yep. This would be a buy stop, the ever confusing stopping myself into a trade, which they really should change the name. I'll use a buy stop order. And that way, if price breaks out, you would get involved. You can also do a conservative version where you would wait for the break and the close, right? As a breakout trader, you don't have to buy aggressively. You can wait for confirmation, the break and the close, and then buy afterwards. And then the third one would be the pullback. You wait for the confirmed violation of that level, confirming your directional bias. You wait for the pullback, giving you a little bit of a cheaper opportunity. And then you look to catch the next wave up. So certainly something you can look for here on the Euro Aussie. And if we go down to a lower time frame, I'm gonna get this into our pro trade log just because I just noticed I haven't written anything there in a while. I've been getting lazy. Maybe we can find a better looking version of this, or even go down to a range bar chart. So let's go to, what is this? Euro Aussie. Now, before heading down to the range bar charts to continue our analysis, as well as share with you an entertaining story about the realistic pros and cons of the range bar charts, if you are someone that is planning on using them, I want to just simply explain what the range bars are for you guys that may not be familiar. That way you don't get intimidated. The range bar charts are no different than any other Japanese candlestick chart. You'll see that the candlesticks are exactly the same. They have opens, they have highs, they have closes, they have lows, they have wicks, they have bodies. The only difference is how they are printed. On your traditional time-based chart, you get a single candle per the time duration. So if I'm on a daily chart, I get one candle per day. If I'm on an hourly chart, I get one candle per hour. If I'm on a 5-minute chart, each candlestick represents a session, which is 5 minutes long. The range bar charts take time. I'm not going to throw my watch, don't worry, because I broke something the last time I did it. They take time out of the equation and they simply focus on movement. So, for example, if I am on a 10 range bar chart, each candle is going to be exactly 10 pips or 10 ticks long. So each time the market moves out of a range of 10 pips or ticks, a new bar will be created. And it gives more of a natural ebb and flow when it comes to the movement. But like I said before, there is a downside, and I'll explain that in a little bit. All right, let's get back to the charts. The equivalent of the 15 would be a 7 range. I'm going to use an 8 range because, well, I told you my things with fibs. Keep in mind that on my range bar chart, my RSI is a little bit faster. So that's why it looks different. And here is your pattern. Here is your level. Boop, 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 right? Again, one of the things I like about range bar charts is you tend to get more ebbs and flows. So you're probably, if you're looking for like a break and close and a pullback, you're probably going to get that quicker here on a range bar chart versus just the regular time-based chart. Probably, I don't know. Everything's different, but because each of these candles has to be in a range of 8, it would eliminate any like big candles or anything like that from the equation. So any questions about this? This would be a lovely day trading setup for a range bar trader. Lovely. Not lovely in the sense that you'd have to sit here and watch it and not do anything else in life, because range bar charts aren't time-based and you never know when those candles are going to form. But as far as a clean setup, it's a nice clean setup here. Emma says, if you're waiting for a pullback on a range bar chart prior to entry, does that mean you have to sit? Oh yeah, there we go. Yeah, just answered it. Yep. Yeah, that was I don't want to say the one negative about the range bar charts, because there's probably more than one negatives, but the thing I hated was that trading on the 5-minute and 15-minute chart, right? It's 8:16 right now, my time. So I can, if I'm waiting on a 15-minute candle, I can go do whatever the heck I want for like the next 13 minutes, right? I can look at my watch. I can go like stretch, take the trash out and be like, all right, okay, 8:28. I should probably start coming back in, right? Knowing that nothing can happen. I can't enter, or nothing, a candle wouldn't be valid until 8:30. The range bar charts, however, you can get 15 candles in 15 minutes. you can get one candle in 2 hours, which is not necessarily fun. So yeah, that is the part that I did not enjoy. And again, I say this jokingly, but it's true. This is something really to consider. I've had times where I've, had my breakfast, had my coffee, and, right? You know what I'm saying? I don't need to explain it to you, right? And, you got to take a little gentleman's break. But there's a trading opportunity on the radar, and you're not sure if you can take that gentleman's break because by the time you get back, the trade may be filled and you may not be involved. So you have to deal, and I'm dead serious here. I know I joke a lot, but this is a real consideration. You've got to hold it. You've got to hold it or risk missing the trades. And I have missed many of trades just getting up from my computer and doing something and being like, really? I was watching this for an hour and I get up for 5 minutes and this is when it moves. So that can be quite annoying. But I suppose that's part of the day trading, the day trading business. Yeah. Let's see, maybe there's something short term you can do here. Oh, here we go. Euro Aussie breaking out. Euro Aussie ascending triangle after a descending move, breaking out. So again, if you are a breakout trader using that buy stop, should be filled already. If you're looking for a higher high, higher close, you are filled right here. If you're looking for a pullback, then you're still waiting for that pullback. Let's see what the... All right, gang, just wanted to come back in and give a little bit of an update on our Euro Aussie trade. As you can see, it's a few hours after we left you guys, and price action has broken up as we saw on the close, and we have now given a nice little double top followed by a retracement. Now, a few cool things about this retracement. One, it does come down and, at least thus far, is holding at a previous level of structure. If we look at kind of how price action ebbed and flowed, we had a nice little consolidative range right here before breaking up. You can see we came right back to that range, and again, we are currently testing it. We would love to see a higher high, higher close here, or another double bottom in its own right. Two, we have a good amount of what's called hidden divergence. So if we take our retracement here, you can see that this low is lower than this previous low. However, if you look at our RSI, our relative strength index, you're going to see that this low is much lower than that low. That is something called hidden divergence. It is typically looked at as a positive sign in a trend continuation setup, which is what this would be. So you still want to wait for confirmation. We haven't gotten this yet, and this goes back to the discussion we had on range bar charts about one of the biggest disadvantages of range bar charts is that, hey, if this were let's say a 15-minute chart, I know that in about 7 minutes, this candle is going to complete, and I know if I'm going to have a trading signal or not. With this being a range bar chart, this candle could complete in the next 10 seconds. It could complete in the next 10 minutes, the next hour. I do not know. So if I am an active day trader, unfortunately, I have to sit here and keep an eye on this thing, which requires a lot of attention until it completes. And that is one of the downsides of day trading, one of the downsides of scalping, which brings to mind a recent Trading Coach podcast episode or YouTube video we did on kind of the pros and cons of scalping if you are interested in that. All right, guys, one more update. I don't know how long it's been since I last spoke to you, probably about an hour or so. But you can see we got a few more candles here. And just real quick, another clue that the market is given. We're getting this tight consolidative area, and it looks like we're doing nothing. We're just doing the sideways shuffle. But once again, if you look at our RSI right here, we're actually putting in a traditional type of bullish divergence. So before we had what was called hidden divergence, which is kind of hard to recognize, but a good sign for trend continuation. This would be called regular divergence, where price action is putting in equal lows, but you can see our RSI is putting in higher lows. This would be a positive sign for a bullish move. So we have both divergences, I guess you can say, lining up and pointing us in the same direction. We still haven't gotten our higher high, higher close yet, which would be, in my opinion, the most aggressive way, or at least the most aggressive way that I would take the trade. But we may see this at the end of this candle if this candle ever completes, which may be any second now. But I got to go record a podcast episode, so I will leave this until later, and hopefully I'm back with good news for you. All right, so I'm finally back after recording the inflation podcast, which I hope you guys have enjoyed already, since you'll be seeing that way before you see this. But wanted to give one final kind of look back at our Euro Aussie situation. Now, obviously we're getting to the later part of the New York session, so not much is going to move. And with this being a day trade, I certainly wouldn't want to enter at the end of the day. But just to play this out, we did end up getting our higher high, higher close right, let me delete some of this stuff here, right on this candle, which again would be an entry technique. So the next question is, how would you set yourself up with this? Well, we already spoke about targets. We can even add a different layer as well, but let's talk about stop losses. If we're going to use a 1 ATR stop, we want to get below this low candle. So with the low of this candle being at 161.56, 1 ATR, which is the average true range, and again, this is a range bar chart, so every one of these candles is 8, which makes the average range 8. We would simply need to subtract 8 from, what did I say this number was? 161.56, which is going to put us at 48. So this would be a 1 ATR stop right here. There's other methods of stop losses you can use as well, but we'll just give you one option right here. So we're looking at an entry at the higher high, higher close. You're looking at an ATR stop being right here if you're using a 1 ATR. And again, we spoke about looking for a move back up to the 62 even handle, the 162 even handle, which would put you right up here. Now, if you want it to be more conservative, maybe you're structure based, you can look for a retest of our previous level of structure. I'll draw that out as well, so you can kind of make a comparison between the two. And again, there's no wrong or right way. Well, there is a wrong way of doing targets, but when you're placing trades off of targets, that may not even give you a 1-to-1, so you may want to be cautious about that. But when you're placing targets, you want to make sure you're doing it in the way that you are personally supposed to do it. So it's not just kind of, hey, I'm doing whatever the heck I want. You're basing it off analysis. You're basing it off a set indicator or level of structure, stuff like that. It should be planned base. So I want to come back in and check up a little bit on our trading opportunity on the Euro Aussie. It is the next day, so about 24 hours later. And bada boom, bada bing. You can see the trade worked out just as we expected. It even did a little bit better than we expected. We did come down. We did threaten this previous level of structure a little bit, but we did not come near our stop loss. And again, I tell this to our tier 1 members all the time, the stop loss needs to be at a place where you believe that your analysis is wrong. So the market is telling you that, hey, this isn't going to work out, but it also needs to be far enough away to give the market some breathing room. So we're not talking like, oh, just put it 1 pip below or something like that, because the market will go down there, grab your stops and reverse without you. Now, I forgot where we had the bigger target. I know our smaller target was at the 162 even handle. We obviously went past that. Our bigger target, if I can remember correctly, yeah, this was a disaster. If you guys remember this from the inflation video, our bigger target was at, sorry, let me get all this stuff up here, was working with a trader on Bollinger Bands this morning. Where was that bigger target at? We were looking at the high of this zone. So yeah, right around here, about 162.24. Yeah, so we well outshot that. And again, if you're a newer trader, yes, you want to go back, you want to redo your analysis, you want to make sure you didn't leave out any clues that might have told you, hey, I could have shot for bigger targets. But going back to our trend trading video, remember that our job as traders isn't to collect every single penny of every single move. Our job is to get in at a quality location, get out at a level that gives us the appropriate amount of profit, but isn't too risky that the market doesn't have a great shot of getting there, and then just repeat the process over and over again. So if you did that, you shouldn't beat yourself up over missing profit, because, well, if we're beating ourselves up over losing trades and we're beating ourselves up over winning trades, we're putting ourselves in a really fragile mental position, and that's just going to lead to disaster. Now, lastly, before I go, I know we mentioned a little bit about the speed of day trading. This is why if you are going to be a day trader, it is appropriate that you have the right machine. Now, this doesn't mean that you need a 20 monitor setup like you see in Instagram Reels and stuff like that, but you should have enough monitors and you should have a setup that is fast enough for you to operate in the market at the speed that it takes to trade these things live. And if you're unsure about what that is, here's what I want you to do. Download this free trading computer builders or buyers guide. It's awesome. It's got all the information you need in there about what needs to be involved in a trading computer, and it's 100% free. I've used it twice in my life, both before buying my new trading computers, and I can honestly say that it was very informative and very helpful coming from someone that knows nothing about computers. So download it, check it out, like, subscribe, and I'll see you guys next time on the channel.